So let me bring up my board, just like in the classroom. So I'm going to write on my board with what I want to talk to you about, and then we follow this and we get it knocked off. So I have a sole proprietorship. What do I do on tax filing? I file Schedule C in my 1040. And what your Schedule C looks like? Your Schedule C is like this. Schedule C, that's of course within your 1040, right? You got a lot of schedules in 1040, remember? Under 1040, you have your first 2 pages. That's the form. Then you have your schedule. Remember, this schedule goes 1, 2, 3, 4, you know? And then you have your schedules A, you have your schedule B, you have your schedule C, D, E, all of these schedules, right? Inside of 1040. But when you are sole proprietor, you are a Schedule C. You do business under Schedule C. So what Schedule C does for you is it asks you for income, ask you for expense, then you have a profit at the end, right? So this profit number, it is literally your owner draw. Whether you draw it or not, it doesn't even matter. It is your owner draw. You finish working and you made this money. So this whole thing will come out of to your 1040 and you will pay 2 taxes. You'll pay income tax, federal and the state. Well, of course, if you're in Nevada, you don't. But if you're in Iowa, you do. Okay, the state tax is so different. So then the other taxes you pay is what? Is self-employment tax. So in sole proprietor world, your owner draw is equals to your profit. But let's say if you say that, well, Ying, I didn't have profit, I had a loss. What are you talking about? But I actually took some money out of my business. I had owner draw, but I had a loss. That is because you are mixing your personal money with your business money. Literally, when you run a business, you didn't make money, but you got an owner draw. And in this case, what that means? That means that you put in money in your business, you're running your business, you didn't even make money, but you took your own money out. So you put in 50, you take 50 out. So those are non-taxable events when you do that. So your owner draw in sole proprietorship situation, it is just the money you made. If you don't make money, it doesn't matter how much you draw. That's your own money. It's like your right pocket goes out of your left pocket. There's no tax event. All right. So I answered owner draw under sole proprietor and what that means. That means you made a profit. But you may say that, oh, I drawed only $1. I didn't draw any dollars. But I had $100,000 profit, but I didn't take the money from the business. I ran the money into the business again. That's too bad because your profit is owner draw. Even though you didn't take it and you invested back in the business, but you still have to pay taxes on the profit because that's your draw. Makes sense? All right. So I am going to save this one and clear this screen and for the next scenario. The next scenario we are going to do is partnership. So in partnership, you use owner draw. You say, I'm a partner. I took some money out of the partnership. So let's see. What kind of way do you have to take money out of the partnership? This is a partnership. Let's assume we're doing, let's say it's a construction company. And, and Joe, and also Francis. These two characters in my first book. I wrote about Joe and Francis. And Joe put in dollars, Francis put in labor. So they have a partnership. So now let's look at the partnership. There's total of 1, 2, 3, 4, 5 ways to take money out of partnership. And all of them could be labeled as owner draws if you're not technical, if you are just speaking loosely. And I'm taking money out of my partnership. 5 ways. Number 1, W-2. You got paid on salary and you say that you're taking money out of your company, out of your partnership. You draw your owner, so you're drawing it. Fine, but that is typically called W-2. That's your salary. So that's number 1 way you take money out of partnership. Number 2 way, guaranteed payment. So what is guaranteed payment? And Joe is the one putting in the dollar. Francis is the one working the labor. And you think it is fair to wait until the year end to split 50-50? Or because Francis is the one working, so we should pay him something. And if it is not a W-2, and Joe agreed that to pay Francis a guaranteed payment of $25,000. Guaranteed payment, of course, is not W-2, but it is an income that Francis will take it to his personal tax return and to pay Social Security Medicare on it. So it will be taxed on income tax and what? Self-employment tax. And this is only 2 of them. What was the other 3? Well, let's throw this one in, capital draw. Say Joe put in $200,000 in the beginning of the year. In the middle of the year, and he came around and said, hey, Francis, do you use my $200,000 up yet? Francis go, no, we just need 100,000. The other 100,000, we really don't need it. Do you want it back? Oh yeah, I want it back. So a check wrote to Joe for 100,000, but this is a capital draw. This is a capital draw. Basically, like he put in the money, he take it out. When he put it in, he already paid taxes for those money he put in. It's an investment. So when he take it back out and he did not take more, he's taking less than what he put in. So he took that money tax-free. There's no tax for it because that's his money. Basically, he loaned the money and he took it out, right? So that is the 3rd way. And sometimes people call it owner draw, but no, they're not owner draw. They're just a capital return, right? Then the 4th one, reimbursement. What is reimbursement? Francis bought a lot of stuff for the partnership, but he bought it on his own credit card. It didn't even land on the partnership financial statement. It is not partnership expenses unless Francis goes, here's my receipt, please pay me, right? That's called a reimbursement. When company reimburse the business expense to employee or to their owner, to you, that is non-taxable. It is simply you spend for the company, so company pay you back. Reimbursement, not taxable. But of course, you should have receipts. You cannot be just sitting here goes, yeah, company should reimburse me for $1 million. And of course, you're the business owner. If you say company owe you $1 million, who is going to stay there and argue with you other than community CPA folks? We sometimes got stubborn and believing that there has to be some mistake. So we would talk to you, not argue with you, but we talk to you to make sure it is correct. So reimbursement non-taxable, folks. All right, then what is the last one? The last one is called the distribution. So in partnership situation, distribution is taxable. And it's taxable on 2 possible ways. One kind of taxable is only income tax, no self-employment tax. The other taxable is income tax and self-employment tax. So what makes it different? So for example, in this case, when Joe gets distribution, remember he only put in the money and he didn't do work. He really was just a passive investor and make it go. And Francis is the one working. So now Joe gets a K1 and that would not pay self-employment tax. But Francis gets a K1 and he will pay both. So that's a distribution. That is sometimes loosely talked about as owner draw. It is not a draw, it's a distribution. And in terms of the partnership, let's say our partnership ended up with $100,000 profit. And a 50-50, so 50K is here, 50K is here, right? And at the end, when you do distribution. But what if Francis was telling you that, no, Ying, you're wrong. I did not get 50,000. I only took 20K. There's a 30K still in the company. I didn't get it. However, the partnership will make you pay taxes on the 50K, and it would, on the back of the book, it will document that Francis only took 30K and 20K. There's a 30K left in the company. So let's say second year come around and Joe and Francis decided to terminate the partnership. And when they terminate the partnership and that 30K, you did not pay Francis, that need to be paid to Francis because that's what he earned. But what if you ended up just eating up all the money in the bank account, bought a bunch of materials, no good, and you just end up with no more cash in the bank? So what's going to happen to Francis? He already paid taxes for the 50K, but he only got 20K, and he had 30K, has no place to put, no place to claim. No, he would have a 30K losses from his operation. So he will actually document that 30K losses in his 1040 on the year when business close. All right, so now let's look at this picture again. So under partnership, when people talk about owner draws, so are you gonna, are you able to say that is owner draw taxable in under a partnership? Can you imagine me sitting back and thinking, okay, what do you mean? What is your owner draw? So you could mean W-2, you could mean guaranteed payment, you could mean capital withdrawal, and you could mean reimbursement, and you could mean distribution, right? So with all of that, it is, at least all type is right here, how that is being taxed. So you will know how to treat your withdrawal out of your company properly. Maybe you withdraw one number, but part of it is reimbursement, part of it is capital draw, part of it is a guarantee pay. See, your accountant has a really big job because your accountant really should give you the breakdown of what is what. So you know which one is taxable, which one is not. All right, so much about LLC. Let's go for s-corp. I'm going to save this. The reason I save it, and I think, Kat, we can post this along with our videos at the end. So that way, when they go to YouTube, they can see all of it. Okay, so let's do s-corp. So we have s-corp. So how many ways we can describe owner drop in s-corp? Now, there is 3. Let me give you those. Number 1, W-2. And we know that under s-corp, and if you make money, you really should have W-2, right? You cannot be like running a corporation with no payroll, right? Then the other one we are going to talk about is reimbursement, which we already covered under the partnership. Reimbursement is non-taxable, right? Then the third one, the s-corp has is distribution. The distribution on s-corp, unlike LLC, remember I was like doing a part, Joe was non-taxable and Francis is taxable. No, in distribution under S corporation is only taxed with income tax. And never, no self-employment tax. So this is one of the reasons why a lot of small companies, small corporations, small company, they are s-corp, because they know that the distribution is actually would go away from self-employment tax. It doesn't pay Social Security, Medicare. For that reason, the government is really caring about W-2, because you can imagine that you run away making income without paying Social Security, Medicare, and that is just not fair compared to LLC. So they want you to make W-2 income when you run s-corp. So when we say owner draw, we are talking about money out of s-corp, what they are. So they may be W-2, that's fine. It's probably taken care of through 940, 941, all of these filing, right? Reimbursement, you better have a receipt to back it up. And you draw out of company account and you say, that's my distribution. Okay, one thing we want to mention to you. Let's say we made $100,000 in s-corp at the end of the year. So you draw, you said that you draw 120K instead of 100K. You drew more than what you made. And then you're going to tell me that, Ying, I drew more because I have it. If I don't have it, I don't drew more. I just, whatever I have, I drew. So I have it. Okay, fine. When you do that, and you are paying $100,000. So let's say you drew 120. So you are actually paying the $100,000 on income tax. Then your 20K is labeled as a capital gain, because you drew more than what you have. We give that word as a base. I know it's a big concept, but the simplest way to imagine base, it is what you have in your pocket over the year. So over the year of S corporation, you made money, you lost money, you made money again, you lose money again. So add in and out, and plus all the money you take, if your basis become a negative, that is your capital gain. That's why sometimes, and people draw the money, and when they got a K1 coming into us from other firms, and they want to file 1040, then they suddenly goes, well, Ying, I don't understand, because I have a lot of capital gain, don't know where that come from, and I actually even had a loss. My K1 is a loss, but I cannot use that loss. So what's going on? That is because the base is playing with you. If you don't have a base, you can't claim the loss, right? It's almost like if you didn't put in money, how could you have a loss? That's just a very simple understanding. If you didn't bet on anything, how could you lose? You must have to put in something before you can claim that is lost, right? Just in the corporation, that calculation is taking years to come, and it is actually sitting on your M2 schedule, on your tax return. So that's why when we take over a new tax client, we are very careful with this base calculation, because we could be the one giving you the bad news, saying that, well, even though you lost $100,000 this year, but you can't deduct anything because you have no base, right? Or we can say to you that, oh, well, you got all these draw and you're over distributing to yourself and you better pay more money on that. So these are where the s-corp comes in, and you need to care about that base. If you had s-corp for years, but you have never ever come across the base issue, that probably because your s-corp has been making money all the time. You never lost money. You always made money, and you always drew less than what you made. If that's the case, you probably don't even care about your base, because you always covered yourself. But if you always lose money, it's a different story. And if you lose money and you draw more, it's even more different story. So this is where when we talk about owner draw, be very careful. You could create tax liability for yourself and under the S corporation situation. Okay, so we're gonna save this one and then go for C corp. We only have 30 minutes, so I want to respect our time. And let's look at the C corp. Under C corporation, C corporation is different from S corporation. C corporation is like a basket. The bottom is sealed up. So what happens in C corp stays in C corp. But your S corporation is different because your S corporation's bottom is actually going through. Going to where? Going to your personal pocket. So it comes into your 1040. That's your S corporation. Actually, this is your S corporation. This is your LLC, right? Your partnership. And they're all act like a thing with no bottom. It just goes through. So you only file return over here, 1120S or 1065, but you really don't pay any taxes because all the result went into your 1040. You are paying it here. Okay, but C corporation is different, and you are paying it here. You don't go anywhere. So this is where how Biden was changing the rate and to the C corporation rate to 21%. Remember, and so it got increased a little bit from 15. So this is the C corporation. It's a flat rate, and here under the C corporation, whatever in here is in here. You pay taxes here. If you want to come out of C corporation, there's only two ways to come out. One way, let's say I'm the owner of a C corp. I only really have two ways, actually three ways, three popular ways that people take money out of C corp. Okay. One way is to pay yourself W-2. So going back to our traditional chart, we call W-2. That is one way to take money out of C corp. There is another way. I'll tell you that this is the way that happens in reality all the time, but IRS has a lot of litigations related to this with large businesses. So one of the court case talking about this business owner borrowed $3.5 million from the business and never paid taxes because when you borrow from the business, it's non-taxable. Right? Because you're gonna pay it back, so it's non-taxable. So that's another way to take money out. But today, remember we focus on owner draw. That's owner draw. That is the owner taking loans out of the company. They take money out of the company. Okay, so that's the second way people do. And then the third one is a dividend. This one we all know because if you buy stock on the stock trading market and at the end of the year, you got a $5.50 dividend payment to you. Don't you remember that? That is a dividend. That is one way to distribute the profit of the C corp. So if you want to penetrate the C corp and make money into your own pocket, the only way you do it is through W-2 and through 1099 DIV, dividend. A lot of our small businesses, when you are under C corp, you're probably not doing this enough. You can enjoy doing this because dividend is taxed lower than the income tax. If your income is under a certain level, which I don't quite remember, I think is under 38K, then your dividend rate is under 5%, right? So the rate dividend is going from 0 to 20 maximum, but our income tax rate is from 0 to 39%, right? So it's very different. So dividend is a lower tax rate. And in here, then you will pay income taxes for the federal, for the company, and then the leftover, it will becoming profit, then becoming retained earning because you have profit every year, so they retain together. And then you can use that to pay dividend. So those are the three ways for the C corporation to pay, to draw. Now, I think I covered all the draws that is there for owner. You have a business, most likely if you follow me, most likely you have sole proprietorship, partnership, S-corp, C-corp, okay? And I know that on LLC and the S-corp, that particular topic can be expanded to an hour, 2 hours, 3 hours. But in general, I think I have given you ideas to know that what is taxable, what is not taxable. So W-2 is always taxable, and the loan from corporation is not taxable. And because you borrow money out and you're supposed to pay back, so non-taxable. And the dividend distribution, of course, taxable, lower tax rate. And then this is the C corp. Then on S corp, we have the distribution that is so tightly related to basis. So that is where, and if someone just coming in to you yourself start doing 1120S tax return for yourself, I would say that you want to educate yourself on base first before you go on to prepare the tax return. Okay, I hope this is helpful, folks. I see a lot of you are out there, and I do see a question on here. Says that, how do I know if I have an S or C corporation? Great question. The way you know is on the tax return. If the tax return is due on March 15, that is S corporation. If your tax person told you that yours is due on April 18 this year, that's a C corporation. So that's one easy way to know. The other way to know is that you normally, if you have a proper, if you have a small business and then you started up here in the US, you don't have any other reasons on the status side. I'm talking about IT numbers and or the immigration status. If you don't have that, or you don't have a divorce and a special situation surrounding you, then C corporation may not be something is recommended by your tax professionals, because C corporation is really, you really have to have a situation, a bigger business in order C corporation to come in. So I would suspect that it might be S corporation. I hope I answered your question. And on Saturday, I plan to talk about the audit done to the businesses by Department of Labor. So I hope that you will find that useful, and so we will go from there. And I'll see you on Saturday. Bye-bye.